everybody, Lisa Dean here with Real Broker, and I am with a friend of mine, Kyle Regan of Movement Mortgage. I've known him for quite a few years, and we're excited to talk to you about a few things. If you are a buyer, he's going to discuss the buy down programs available here at Movement Mortgage, as well as the difference between those and ARMs. And then we can talk about the paperwork that you as a buyer would be responsible for providing to get that pre-approval letter. So here we go. Thank you, Kyle, for meeting us today.
Yeah, of course. Thank you for having me. We've been kicking butt together for a long time now.
I know, so excited. So I want to make sure you guys get some great information, and Kyle's like one of the best to get that to you. So why don't we begin? So why don't you tell us about like a 3-2-1 buy down or a 2-1 buy down, and pros and cons, things like that.
Yes, definitely. So it's a very common question right now, especially with how interest rates have risen over the past year and a half. A constant question I'm getting is, how do I keep my interest rate as low as possible? That is a hot topic. So there's a couple different ways to do this. So one of the more popular ways that we can keep your interest rate as low as possible are something called buy down options. So there's a few different ones out there. I'll give you like the general take on how they work and what their pros and cons are. So there are buy down options that are called a 3-2-1 buy down option, a 2-1 buy down option, and a 1-0 buy down option. And there's a permanent buy down option.
Okay, let's keep track of that.
So I'm going to go through each one by one.
Yep.
So a 3-2-1 buy down option, basically getting your interest rate lower than market value for a 3-year period. So that's the 3 part of the 3-2-1 buy down.
Okay.
So the idea in any of these buy down options is to keep your interest rate low and as low as possible in the interim while we're hoping interest rates start to tick down and come down. It should give you enough runway to have a really awesome interest rate and a lower payment, and give you enough time so that over the next 3 years, rates hopefully come down, and you can refinance out of this buy down option into a fixed rate that's a little bit lower than what's being offered right now. So a 3-2-1 buy down option works like this. It's very simple. So for the first year, for the first 12 months of your loan on a 30-year loan, right? The first 12 months of payments that you make, your interest rate is 3 points below market value. So say interest rates today are at a 6.375 for a 30-year fixed. Your first 12 months, your payment is based on a 3.375% interest rate. That has a massive impact on your monthly payment. So your monthly payment is going to be a heck of a lot lower than it would for the first 12 months if you were to take today's market value at a 6.375. So first year is the 3, so that's 3 points below market value. The second year is the 2 part of that 3-2-1 buy down. So the second 12 months, months 12 to 24, your payment is 2 points below market rate. So again, rate 6.375 today, roughly for a 30-year fixed. You're going to be at a 4.375 for the next 12 months. Your payment's still going to be substantially lower than it would if you were to just take the 6.375. The third year, that's where the 1 comes in. So this is the last year that your rate is going to be lower than market value. So that 24 to 36 month period, that last year, the third year, your rate is going to be 1 point below market value. So that year, again, say today's rate is a 6.375, that year you're going to have a 5.375. Your payment's still going to be a good chunk lower than it would be if you had a 6.375. So the savings that you're looking at is incredible. You know, that first 12 months, your payment's super low because you have a 3.375. The second year, you're gonna have a 4.375, and the third year, you're gonna have a 5.375. Now, if you don't refinance out of this product, and this is what's kind of cool, is you can refinance out of this whenever you'd like. So say rates come down massively next year, you can refi out of this with no penalty. But if you do not refinance out of this, your 4th year through your 30th year, it will go back to the market rate as what it was when you first bought that home, 6.375. And you're gonna have a 6.375 from year 4 through 30. So that's the 3-2-1 buy down. Now these other buy down options are very similar. The 2-1 buy down, similar idea.
Right.
Where the first year of your payment, you're gonna have a market rate 2 points below today's market rate. So your first year, you're gonna have a 4.375. Next year, it'll be a 5.375. And then years 3 through 30, you'll be back at the 6.375. Now the 1-0 buy down that we here at Movement offer exclusively, which is really cool, and this is one of the knocks to the buy down options right now, is these buy down options, the 3-2-1 or the 2-1, they're meant to be paid by the seller of the home through seller credits or seller concessions, same thing. But if you were to break the numbers down, and because these buy downs cost money to get, if you were to look and say, okay, well, what if the buyer paid for it? Does that make sense? If you do the math and you look at the cost of how much it takes to get one of these 3-2-1 or the 2-1 buy down options, you actually don't make up that amount of money in your month-to-month savings. So it's not meant to be paid by the buyer. It's meant to be negotiated and paid for by the seller out of the proceeds of their sale. Now the knock to that right now, it's not impossible to get, but it's a little bit more difficult because it's so competitive.
Yes,
so
I would agree.
Yeah, and Lisa's definitely seeing that right now in today's market, that it's tough to go into an offer situation when you're against other offers and be asking for money back from the sellers to go towards, an interest rate buy down. So they're really awesome if you can get them, and they're perfect in the right situations. If we, Lisa does some digging and we feel that there's not a ton of action on this home, that we feel like we can negotiate this, awesome. If it's a busy open house and Lisa feels like there's a lot of offers on this property and she does some digging and she's having those conversations with listing agents and we know that there's action on this home, it might not be something that we want to include in your offer because it could hurt your chances of getting your offer accepted.
That is true.
So that's where the 1-0 buy down that Movement has exclusively, this is really cool. So the 1-0 buy down is paid for by Movement in the form of a lender credit. So we cover the cost of this option for you, which is pretty cool.
Yeah.
So you're gonna get an interest rate 1 point below market value for the first year you own the home. And it might be a better option than just taking today's current market rate and having that the whole 30 years. At least the first year of you owning this home, you're gonna have a little bit lower payment. It helps you ease into home ownership a little bit. Get your feet under you, kind of learn to see what it's like being a homeowner, get all your bills in order and learn how to pay a water bill and maintain the property and things like that. And you're gonna have a little bit more wiggle room because you have that 1-0 buy down option, and that's paid for by Movement Mortgage. So that one's really cool. Now there's one other option too, that you can do a permanent buy down. So you can actually spend money up front and invest in your interest rate and buy down your interest rate, and the buyer pays for this up front. So this would just get added to your closing costs. And this is gonna lower your rate as well. Typically, the rough math of it is if you purchase about 2 points, so 2 points is 2% of your loan amount. If you purchase that and that 2 points gets added to your closing costs, that should lower your rate about 3/4 of a point to a full point in the rate. Your rate will stay that low forever. The only knock to that is if interest rates come down, over the next year, 2 years, 3 years, and we do the math together, and I'm always gonna look at this with the buyer, and we see that you might not make that money back So the idea of a permanent buy down is you're investing in your interest rate today, but it's a long-term win.
Right.
You know, so you're saving money each month for the next 30 years, and it might take you 3, 4, 5 years to break even, to make back what you invested in that interest rate up front. But if interest rates come down in 1 year or 2 years, you might actually lose money doing that option. So that one is a case-by-case basis. We're gonna see kind of what that looks like. So that's how the buy down options work in general. They're great options to be able to have the ability to get your interest rate lower, you know, and get a lower interest rate than what's being offered today. Other options are adjustable rate mortgages.
Right.
So
what's the difference with that?
Yes, so adjustable rate mortgages, or ARMs, that's the acronym that you'll see pop up a bunch. These are fixed for a certain period of time. So they're not like the old school ARMs that have a really bad rap from 2008, 2009 and prior. Those ARMs that they were offering in the mortgage world were a lot riskier than what's offered today. Because the ARMs, or adjustable rate mortgages that are offered today, have way longer fixed periods. So there's typically a 3-1, a 5-1, and a 7-1 ARM that are available. So just recently switched these to a 3-6, a 5-6, and a 7-6. So yeah, a little confusing. But the first,
keep up with them all.
yeah, a lot of changes happen in the mortgage world frequently. So basically, to make it simple, is the first number in that breakdown, whether it's a 3-6, a 5-6, or a 7-6. There's also 10-6, but just to keep it simple, that first number, the 3, 5, 7, or 10, that's how long the mortgage has a fixed rate for.
Okay.
So the adjustable rate mortgages have a fixed period where your rate is fixed for a certain period of time. So a 3-6 ARM is going to be fixed for 3 years. So whatever interest rate you lock into, that rate is going to be fixed for 3 years. After that 3 years, the rate has the ability to adjust every 6 months after that. So that's where if you get an adjustable rate mortgage in general, you want to be keeping an eye on the interest rates, because the goal with an ARM, or an adjustable rate mortgage, is that you get a rate that's a little bit lower, because the pricing in some occasions can be a little bit sharper on adjustable rate mortgages. That's why they're advantageous and people are looking at them more and more now. Is the interest rate's a little bit lower, but it's a tiny bit riskier, because that rate after the fixed period, it could either be fixed for 3 years, 5 years, 7 years, or 10 years. After that fixed period ends, the rate has the ability to adjust. So you want to keep an eye on that. So if you play your cards right and you're working with the right team and the right lender that is also watching over your rates for you and making sure we're keeping an eye on this, if you can get a little bit lower of an interest rate with an adjustable rate mortgage, and you can keep your rate fixed for 3 years, 5 years, 7 years, and you can refinance before that rate starts to adjust, and hopefully over that 3 years, 5 years, 7 years, 10 years that your rate's fixed with the adjustable rate mortgage, that hopefully interest rates come down, and that you can refinance into a fixed rate, not have to worry about your rate adjusting at all, and you refinance before it hits. So that's another popular product that is also being offered right now in the mortgage world that we're taking a peek at with everybody that we talk to.
Excellent. Well, thank you so much. And if you can tell everyone who's watching kind of what paperwork they're going to need to help get the ball rolling and started to get that pre-approval and decide which loan product is the best option for them based on their financial situations. What do we need?
Yes, to get the ball rolling. So as soon as you have those gears going in your head that you want to buy a home, the first place to start is always the pre-approval. The pre-approval is going to answer a lot of the questions that you probably have bouncing around in your head. Things like, you know, how much of a loan is a bank willing to give me? You know, what am I pre-approved for? What's the amount? What do payments look like? How much money do I need out of pocket to make this happen?
Right.
That is all going to get answered through the pre-approval process. So to get the ball rolling there's a couple things that we'll get in order. So the very first thing that we're going to do is have you fill out a mortgage application.
Right.
So that's step one. Basically, a mortgage application is going to give us all your upfront information to give us a clear picture of your financial situation. And we're also going to grab like your upfront pedigree information, your name, your date of birth, your social, your living history, your work history, how much money you have sitting in the bank currently. So the mortgage application is going to give us all your upfront information, and then we kind of verify all of that information in the application through documentation. So when you fill out the application, and our application is online, it's very user-friendly, easy to use. It's a one-stop shop. So you fill out your application, and then our application will prompt you on what documents to upload. So if you're a W-2'd employee, whether you're salary or hourly, you're gonna upload a few things. You're gonna upload a copy of your ID to verify this is actually you who just filled out the application. We are going to ask for 2 years of W-2s to see how your income's been trending. We're gonna ask for your 2 most recent pay stubs to make sure that you're still earning that same amount of money that you have been, if not more. And then we're going to ask for typically 2 months of bank statements to verify that you have the money sitting in an account somewhere in general to have the money for down payment and closing costs. If you're self-employed, tiny bit different, but very similar. We're still gonna ask for that ID to make sure it was actually you that filled out the application. So ID, and then if you're self-employed, depending on what type of business you own or run, we're gonna typically ask for 2 years of tax returns. And it'll depend on what type of tax returns you file, but typically it's going to be 2 years of personal and business tax returns. If you're a 1099 employee, it would also include 2 years of 1099s. And then the other items would be the 2 years of bank statements to, again, verify that you have the money on hand to buy a home with down payment and closing costs.
Sounds good. Well, that's a lot of information. So I hope you re-listen to this video so you can really have it sink in, and that way you're prepared. So, and then once you've got all those ducks in a row and your financial house in order, definitely let's get together so we can take, you know, baby steps to find that property that you are certainly looking for, and for you and your family. And of course, I'm here to help. My information is going to be down below here, so feel free to reach out, call, text, or email me. My clients do reach out when they see these videos, and again, I'm honestly here to help you moving forward. And Kyle, thank you so much for taking the time to really explain these particular loan products. There are more loan products out there that lenders do have available to their clients. But I'm also going to keep your contact information down here below as well, so
awesome.
Our viewers can reach out to you directly.
Perfect.
Right?
Yeah, sounds like a plan. Thank you so much,
Thank you guys
Lisa.
so much. Thank you so much. All my best, and keep smiling. Bye-bye.